The Sensex and the Nifty both zooming in trade today. The Sensex ending nearly 500 points up above the 65,000 mark for the first time. And the Nifty also up nearly 150 points, closing up above the 19,300 peak again for the first time. Kartik and Suyash can join us in the studio, and we also have Mr. Mohit Gang, co-founder and CEO of Moneyfront, joining us on this broadcast. I'm going to begin with Kartik. Kartik, talk to us. Markets have been on a roll last week, and it seems like there is no end to that roll. It's continuing.
New highs every day, and I think the fears of the markets being overheated are absolutely right now. And I, for one, am really skeptical. Is there going to be an event where these highs that we are seeing every day will stop happening, and rather the reverse would start off? I don't know.
Well.
19,322 on the Nifty, 65,205 on the Sensex. Both well above the 65 and 19,000 levels respectively.
Right, fantastic. Suyash, talk to us. Tell us, give us a lowdown of what it was, what trade was like today. Who are the big gainers? Who are the big losers?
So this was a sixth consecutive session of gains for the Dalal Street. Now today's rally, the main contributors were banking and financial stocks. Nifty PSU Bank Index was up about 3.6%. Financial Services Index was up about 1%, and Nifty Bank ended at about 0.92% higher. Now, on the other side, IT and pharma stocks witnessed some sort of profit booking. Nifty IT was down about 0.5%, and Nifty Pharma fell about 1%. Now, among individual stocks, Grasim was the top gainer in the Nifty pack. It rallied about 3.4%. BPCL, ITC, Reliance Industries also surged about 2% today. Among losers in the Nifty pack was Power Grid Corporation, Sun Pharma, Bajaj Auto and Cipla. All of them were down about 1%.
Right, so that's a quick roundup of what the trade was like today. Kartik, also a first day of trading for the new merged entity of HDFC Bank and HDFC, which is now just officially HDFC Bank, also doing well in trade today. As you're talking about banking stocks doing really well in trade today. We have Mohit Gang, co-founder and CEO of Moneyfront, also joining us on this broadcast live. Mohit, thank you so much for taking time out to be with us. Talk to us. 65,000 peak has been scaled on the Sensex, 19,300 on the Nifty. Banking stocks doing very well in trade today. However, IT and pharma seeing some profit booking.
Yeah, so look, I think Krishnakumar, we had a conversation some few days back also, and I think the momentum has been ferocious in the market, for lack of better words. The underlying current is so strong, and the momentum trades are now heavily loaded in favor of the bulls. So look, obviously, I think everything looks hunky-dory as of now as we speak. There are no negative alarms for me to be raising on this show. India continues to be a shining story relatively and absolutely both, basically, right? So you are the fifth largest economy, you're going to be the third largest economy in next couple of years. And you see the GST collections, you see the manufacturing PMI, you see the inflation numbers, the interest rate cycle kind of looks like it has peaked, and everything is speaking in favor of the markets. The story looks rock solid right now, and the ship is sailing smooth. And as I think one of you guys pointed out, unless there is an event which unfolds, which is unforeseen, or there is some global shocker which comes out, right now it looks fairly pretty, honestly, on the screen.
Okay, if I were to ask you, what should be the investment strategy of an average, person who's investing, in financial products linked to the stock markets? What is the right way of going about it right now? What is the kind of funds that one should invest in? Because they say that the mid caps and the small caps are overpriced in the market at this stage. So is it a good time to just buy funds on indices and also large caps and blue chips?
Look, so I have a little bit of a contra view on this one. Honestly, to my mind, mid and small caps have rallied after a fairly long course, and they aren't looking as expensive on the screen. Look, if you were to see the Nifty small cap index per se, it is quoting roughly at around 20 times current year multiple, which is absolutely nothing for a small cap index when your Nifty itself is quoting almost a 21 times earning multiple. So relatively speaking, a small cap index has never been cheaper than a Nifty broader index itself, which is happening currently. The mid cap index also is quoting somewhere in the range of around 26 to 27 times earnings multiple, which again is not a expensive zone for a mid cap index in India, and historically whatever we have seen, right? So these two indices are not very costly. The larger index, yes, is a little costly right now, but not like way off the charts that it seems dramatically costly. And look, what will also happen gradually is that right now we're looking at FY24, right? Within a quarter or so, we will start discounting FY25, and then again it'll start looking pretty reasonable to all of us. So I think market is kind of factoring in all that. Plus, market is also factoring is a huge election year, and I think there will be a lot of ground spending which will happen. There are state elections which are likely to happen this year, and then the general elections next year, and all of this historically has given a huge boost to consumption on the ground level because there'll be money spent on the ground, and I think that helps local consumption. So all in all, as I told you, it looks fairly good. To answer your second part, which is what instruments look good, look, I've always been a stronger advocate of mutual funds if you're not directly sitting in front of the screen 24/7. If you're not one of those who have
Fair
hands
enough, Mohit.
on the
The question was like, what kind of mutual funds? Because you have large cap funds, mid cap funds, small cap funds, flexi cap funds, index funds. What seems like a safe bet right now? And also, if somebody is entering the market right now with fear that oh my God, this is an expensive market, and what if there's a correction couple of months down the line? With those fears, who's entering the market?
Okay, I got you. So look, I think if the right approach is always to follow your asset allocation, go with the asset allocation approach. So if you're underweight equity, obviously you have to go into equities right now. And within equities, if you honestly ask me, I am comfortable today allocating into mid and small caps. As I told you, if you are underweight within the overall equity basket, also you have to see how you are positioned relatively within the large, mid, and small cap zones. And if you are, let's say, even neutral to underweight on the mid and small caps, I would then want you to take the positions up into these two segments and build your positions from here. How to build can be debated. And I think that the right way is through an SIP or an STP. I would still not recommend that investors jump in with a huge pot of lump sum at this point in time. It's better to stagger out for next 6 months to a year kind of a time frame, and that to my mind is the right approach. But yes, mid and small cap can be considered provided you are not heavily allocated already and you are equal weight or you are underweight these two segments, then one should enter mid and small caps. Otherwise, obviously, if you want a slightly more safer zone where you don't want to risk your capital erosion in times the market's correct, then yes, large caps have always given that cushion and will continue to give that cushion. But if you ask me one line answer, I think mid and small caps could be considered at this level also through a staggered approach.
Mohit, I want to come back to the banking and the financial space. It has been pretty active lately, and the Nifty Bank also touched a lifetime high today. So what's driving interest, buying interest in the banking space? And is it overheated, or there could be more upside in the offing?
Look, I think banking always is the lead indicator of the economy. And BankX has always provided that impetus whenever the economy looks good and everything is going on good. Plus the interest rate cycle, which has already peaked, is a big trigger for the bank books itself, right? As the interest rate cycle reverses, which can be perhaps 6 months down the line and not immediately, but the banks will have a huge mark-to-market gain on their bond portfolios, whatever they're holding. So that's point number one, and I think market is already discounting that. And the second part, which is the most critical part, is the PSUs have been laggards for many years put together. It's just that this year, typically we have seen the PSU banks rally a lot, and I think look, it's a story of cleanup all across. If you see the NPAs, if you see the numbers and the kind of profitability that the PSU banks have been putting up, that's all at all-time highs, right? The NPAs are at an all-time low, and the profitability indicators are at all-time high. So it's a long overdue kind of a rally. So PSUs have rallied. Some names are still catching up to that thing. So I think predominantly it's a PSU-driven rally. Smaller PSUs per se are now catching up to the bigger names and are catching up to the private banking peers, which have already run up quite a lot. So I think that's the zone which is looking positive right now.
Right. Mohit, if I were to ask you, keeping with the banking space, you're looking at the first day of trading for the new merged HDFC Bank entity. Talk to us about that stock, from the way it traded on day one.
Oh, look, it's an all-time high now, right? And technically, everything indicates to a good momentum from here on. It'll be a $17 billion kind of an entity when it comes on the market cap front. It's still nowhere compared to the leading banks globally, but it's become it's like one of those too big to fail kind of institutions, not just in India now, but globally also, right? So I think from that perspective, it's a great buy. And though obviously there will be some rebalancing on the index portfolios across, because few of those index funds and ETFs which cross the limit, let's say a SEBI defined limit of 10% in each fund, they can't have more than 10% exposure in a single stock. So I think there we will see some trimming out. Across the other categories of funds where fund managers continue to hold HDFC Bank and HDFC Limited both, I think there'll be some shuffling within the portfolios, because there'll be many schemes where they could afford more of HDFC as a combined entity. But index funds and ETFs could see some selling pressure, but I think there is enough and more appetite in the market with the FIIs pumping in a lot of money and overall looking good. I think it is showing good signs of a long term buy still till now also.
Mohit, talking about FIIs now, FIIs had been, for institutional investors, had been net sellers for the last 2 financial years, but since the start of FY24, they have contributed over $10 billion in the Indian market. So why are they so gung-ho about the markets? What's driving this optimism?
So I don't know, better late than sorry. I think they've kind of realized that the party is on for long, and the fundamentals of the ground level stories are changing. Honestly, I think it is some bit of China story also, which is played down to a large extent. This role of FII is coming back to the Indian markets, but I think look, domestic story was fairly strong last full year, and perhaps foreign investors have realized that the kind of domestic flows and the domestic confidence which investors have been showing is phenomenal. Plus the ground level turnout. I'm just talking of some small indicators. Look at the GST collections right now, right? 1.67 lakh crores last month and 1.87 lakh crores a month before that. Those are all-time high numbers, and they are slated to go up again, right? Even if you have an average monsoon by all indicators, you will still have earnings growth of around 10 odd percent this year. And a Nifty EPS of over 1,000 for this financial year end, right? So those are all great stories. You have phenomenal amount of interest right now from not just domestic institutions but all the foreign players, and plus that India shining story all around. A stable government is helping the courts, and though elections are big trigger points, I'll again repeat that, and there could be an event risk around that. But as of now, the way it looks like, it is a great story for India which is going on, and
Hey
everyone wants
Mohit,
to have a
hi
piece of
Mohit,
cake.
Kartik here.
Hi,
Just wanted
Kartik.
to get your view on the fact that this also happens to be the time, and I want to bring this back to the end consumer, the investor. This happens to be a time when increments have been rolled out, and a few lucky folks out there would have possibly got some hefty bonuses. So, would it be a prudent time for them to invest directly in equities right now?
Oh, look, I've always been maintaining that the right time to invest in equities was yesterday, and today is the second best day. So obviously, if you've got your fat bonus checks,
Technically, you're right, because it's scaled new peaks today as opposed to yesterday or Friday for that matter.
totally.
But a lump
I
sum direct equity investment route, is it a good time right now? I know
no.
it's difficult to time markets, but with your experience and having looked at the whole graph over the last so many decades, is this the right time to bite directly?
No, not direct equity, to be very honest, unless, as I told you, you are a pro in front of the screen and you have your hands completely into it.
Yeah.
Otherwise, I think go with an index fund. Look, I think you never go wrong with those simpler instruments, simpler mutual funds, basically. Just pick up a right index fund, a low cost instrument, and you will never go wrong. Start with a staggered approach. You don't have to like put your entire 100 rupee of bonus into it. Stagger it out for next 6 months, but get in today itself, right? So don't delay the entire process, because markets will prove you wrong eventually if you keep waiting on the sidelines, and that's the nature of the market, right? So you just have to get in. If the money is for long term, go ahead, buy an index fund, and if you're already invested, you already have an existing portfolio, then yes, do definitely look at increasing your mid and small cap allocations. I think the story is good. If you have a 5-year tenor, you should dabble into it.
All right, all right. I have one last quick comment I want from you. We are at the 65,000 peak. We're in July. Where do you see the Sensex ending the calendar year?
Oh no. So look, don't put me onto this spot. I would just like to say that a famous couplet which says "Sitaro se aage jahan aur bhi hai." So I'm sure there are many more skies to be conquered. But
Fair
yes, you
enough.
will have interim volatility, and people have to be cognizant. Don't please jump in and rush in to make that quick buck. Be very aware of your risk profile and just dabble in small and nibble small.
Oh, lovely. Thank you so much for that piece of advice, Mohit, because amidst all the frenzy, amidst all the peaks being scaled, Mohit Gang, co-founder and CEO of Moneyfront there, rationalizing it for you. So it's all good. You should have gone into the markets yesterday, but in case you're going into it today, slow and steady is the approach. One little bite at a time, staggered investment over the course of the next 6 to 12 months is the word coming in from our experts.